board Mr. Kamakodi, the MD and CEO at City Union Bank, to talk about how he's benefiting and how much he's benefiting from the RBI move. Mr. Kamakodi, good to have you today. Tell me, how much of the rate cut is going to fuel the overall credit growth? Because after 2011, this is the first time that one has seen PSU banks have outperformed private sector banks in loan growth. Tell me what's driving this growth, and do you expect this to really sustain?
Basically what is expected is the reduction in the interest rate. Perhaps it will start with the consumption first, maybe like the housing loans and other vehicle loans and sort of retail loans. After that, it has to get into the, let's say, particularly on the investment cycle of the industries when the capacity utilization increase. This is how things have performed in the previous rate cycles. One difference now is that, like in the earlier cycles and all, we could see the beginning of the investment cycle from the corporates coinciding with the reduction in the interest rate. But this time it looks probably like we are slightly behind that. So overall, in fact, when the after the like COVID for a couple of years, the industry credit growth fueled by the let's say the consumption, particularly the onward lending to the NBFCs, you had higher teens and even up to 20% in the couple of years. So last year, for the financial year 25, the industry growth rate was somewhere around 12 to 14%. So another 2-3% incremental growth for the industry, like credit growth, can be expected this year, fueled by the rate cut cycle.
Could you help us understand that what this rate cut will do to your NIMs? The reason I ask this because the street was expecting almost a 25 basis point of cut, which was expected to have impact on the NIMs of the banks in the negative way. But this time, a 50 basis point of cut has come in, but with 100 bips of cut in the CRR as well. So help us with the picture. What will it do to your NIMs going forward?
Yeah, it is quite obvious. The net interest margins of the bank expanded during the increasing interest rate cycle and decreased during the decreasing interest rate cycle because the assets gets repriced quickly. And the term deposits, it takes slightly longer time with a lag effect to get repriced in tune with the reducing interest rate. So basically, as it was pointed out during the discussion by the regulator, that the rate cut cycle is front-ended. Obviously, the repricing of assets will happen faster in a short term, maybe about 5 to 10 basis point cut. But another important aspect is the repricing of the deposits also will happen much, let's say, deeper. So year as a whole, the things will get averaged out. So the net to net, the impact on the margins will get averaged out, but there will be some difference or like say fluctuations in the net interest margin during the middle of the like say quarter. And the reduction in the CRR was something unexpected, which is also going to improve the like say help the banks to lend that money and get some extra interest income. So net of net, if you look year as a whole, the rate cut and also the cut in the CRR is going to be helping banks to, let's say, maintain their margin in a better way compared to having, let's say, just a quarter percentage rate cut on an ongoing basis. It's really, let's say, even though you may be having a short-term impact, but year as whole, things will get averaged out and probably help the banks to better manage the margins.
Okay, Mr. Kamakodi, point taken. But while we're talking about your financials, let's also talk about your cost of funds, because even after the previous two rate cuts that we've seen earlier, your cost of funds has inched up around 4.95% in Q4. Help us understand how much reduction in the cost of funds is expected going ahead on the back of this latest RBI action.
Basically, if you had a chance to look into like the much of the rate cut happened after the February. we had only few weeks in the third quarter, which actually helped the rate cut cycle and subsequent reduction in the deposit. In fact, the pass on to the deposit was not complete last time. But this time going forward, finally, when you have about 1% CRR cut that has happened in the last 3-4 quarters, 3-4 months, you will at least have not less than about 75 basis point getting passed on to the term deposits. And overall, it will happen with a lag effect, and we expect towards the end of the last quarter of the current financial year, we will have about 75 to 100 basis point impact on the cost of deposits.
Right. Mr. Kamakodi, also I wanted to understand how much of your loan book is EBLR and how much is MCLR. Until now, how much rate cuts have you actually passed on to the consumers?
Basically, we have, about 25 to 30% is EBLR, and another about 30 odd percentage is from the fixed rate, and the balance about 30 to 35% is from the MCLR. By and large, they are approximately evenly balanced. So before the month of the current year, almost apart from whatever we had done earlier, another 50 basis point reduction in the passing of the EBLR will happen in a few days time from now.
Okay, and let's talk a little bit more about the impact of these rate cuts that we've seen. Do you expect to see an increase in the balance transfers as the rate cut transmissions for some NBFCs is a little more than banks?
See, that difference had already been there even before this rate cut. So the customer chooses his, a lender where, it depends upon his risk profile. It depends upon how much risk the banks or the lending institutions like NBFCs, they take a call. And what we ultimately, the balance transfer, for example, almost in an efficient market, the overall reduction will be almost identical. And yes, there will be some incremental impact, but it's not like you will be seeing, almost everybody getting migrated from the NBFC to banking sector or whatever. We don't expect something like that.
Okay, and before we move on, Mr. Kamakodi, just one last question I want to take with you. The impact on the bond portfolio of your company, where do you see this impact? Because how much of your bond portfolio is held to maturity and how much of it is currently available for sale?
See, almost we have 60 to 70% in HTM and balance in the AFS. And because of the rate cuts that happened in the last, 2-3 months, significant reduction in the bond yield, which you have already seen, has resulted in the good appreciation in the bond book. And the treatment on, how you have accounting treatment for the AFS and, the 5% ceiling you can have on booking on the HTM book. So the changes in the rule that happened, a couple of quarters back, in fact, it has helped the bank to better manage the investment book. In the past, before this new regulations got into force, you had to go for mark to market on a continuous basis. But now the mark to market is now, when you don't actually book the profit or loss, it is getting adjusted in your net worth directly without going through the P&L route, which is helping the banks to better manage the, have better risk control mechanism for the investment book per se.
Mr. Kamakodi, so good having you on the show. Thanks as always for getting your time in. Let's try and understand what China's curbs